A very happy day to all of you and welcome to my YouTube channel. I'm your learning partner Sushila Hariharan. In the last week of December 2021, SEBI, that's the Securities Exchange Board of India, announced some new rules with reference to the IPO process. The rules are expected to be implemented in the new IPOs of 2022, and there are some significant changes that have been introduced by SEBI, especially for companies that want to list on the NSE and the BSE. In this video, let us take a look at what are the new rules that have been announced by SEBI for companies that want to issue the IPO and whether there is any real benefit for the small investor. As we're all quite familiar with the IPO as a concept, I'm not going to really explain that, but I will straight away jump into the old versus new rules. The first new rule is about the price band. As we all know that during an IPO, a company issues an IPO and announces the price band. By price band, there is a upper price and a lower price. This is called as the lower band and the upper band. It is within this band only that investors can apply for the IPO. In the old rule, companies had a free hand to decide the price band of the IPO. What does this mean? If a company announced an IPO, it could keep a band as narrow as 100 rupees as the lower band and 103 rupees as the upper band. So all investors who wanted to apply for the IPO had to apply only within this very narrow band of 3 rupees. That was not really serving the purpose of having a price discovery process. So the IPO price, as we all know, is discovered through book building. If the book building has such a narrow range, then it obviously appears to be concentrated towards the larger investors. What does the new rule say about this price band? The new rule states that the upper price band, that is the cap, has to be at least 105% of the lower band price. This implies that there is at least a 105% variation between the lower price and the upper band price. So, for example, if a company announces an IPO and it announces the lower band at 100 rupees, then the upper band has to be at least 105% of the lower band price. So, if we say the lower band price is 100 rupees, the upper band price is 105%. Therefore, 100 plus 105%, that would mean 205 rupees is the upper band. So, as per this formula, the IPO band price is now upper band at 205 and lower band at 100. Now, with this wide variation, what happens? The small investors get an opportunity and a fairer price discovery by understanding in which segment or at what rate they would be willing to apply for the IPO. So this was the first regulation that was announced by SEBI. The second regulation is with reference to the IPO funds. When the company announced an IPO, it was not mandatory for the company in the earlier days to give a breakup of how the money was going to be utilized. So companies came up with huge IPOs running into thousands of crores of rupees, but there was no requirement for them to disclose how the money was going to be utilized in specific terms. SEBI found that a little annoying, and therefore they introduced a new rule which said that if the company is going to use the IPO money for general corporate purposes, then they can use only a maximum of 35% of the IPO funds. So if a company raises IPO money of 1,000 crores, then for general corporate purpose, now general corporate purpose could be anything. It could be payment of salaries, it could be payment of vendors' outstanding bills, it could be payment of electricity. But companies should not be using IPO money for these kind of working capital expenses. So therefore, under the new regulation, SEBI says The amount that a company can use for general corporate purposes is capped at 35% of the IPO funds. Another example of the regulation is if the company says we are going to use the IPO funds for mergers and acquisitions. Now, mergers and acquisitions is a generic term and it involves a series of activities which could run anywhere between 6 to 18 months. Therefore, SEBI says that if you are going to use the IPO funds for acquisitions, but the acquisition target is not identified, then the max that the company can use for this activity is capped at 25% of the IPO funds. So, unless the company is already in the midst of a acquisition discussion or an acquisition transaction, and there is very clear aspect about how the funds is going to be used, the new rule is very clear. The company cannot issue more than 25% of the IPO funds. The third rule is about the role of the anchor investors. Who are the anchor investors? Anchor investors were introduced in the IPO regulations of 2013 in order to enable companies build the book and enhance or enable a proper price discovery. The old rule for anchor investors was there was a 30-day lock-in period for the anchor investors. 30 days from the date of allotment. And after 30 days, the anchor investors could sell off their entire shares in the market. We saw this happen in the case of Paytm. Paytm did an IPO in November, it got listed in November 2021. And in December, the anchor investors, many of the large anchor investors sold out their shares. This resulted into Paytm hitting almost lower circuit on one particular day. The new rule says that anchor investors cannot sell their entire holding on a particular day. So they've given it in two tranches. After the first 30-day lock-in period, anchor investors can sell 50% of their holding. Now look, anchor investors are already holding crores worth of shares. Okay, so their transactions of selling in the market can create a big ripple effect and can cause the market to completely collapse in that particular stock. So therefore, in order to provide price stability and not encourage unnecessary speculation, anchor investors now have to have only a 30-day lock-in for being able to sell out 50% of their holding. They have to hold on to the remaining 50% for further 60 days. That is 90 days from date of allotment. The remaining 50% is still locked in and then they can sell out the remaining 50%. So the new rule has broken down the ability of the anchor investors to sell in tranches. Okay. Now this 30 to 90 days is only kept as a lock-in period for guidance purposes. Investors who hold the shares, anchor investors who hold the shares can sell anything up to that. They don't have to. If they like the company, they like the company's management, they like the company's stock behavior in the markets, they can continue to hold on to it. The lock-in period unfreezes for the first 50% after the first 30 days, for the remaining 50% after 90 days. The fourth rule is for non-institutional investors, also called as HNI or high net worth individuals. The non-institutional investors, but not the small investor, were having a quota of 35% of the IPO was reserved for them. Under the new rule, this 35% is further broken down into two segments. 1/3 of this quota is reserved for investors who apply worth 2 to 10 lakh rupees. This category of investors this subcategory of investors has been created who are neither small investors nor high net worth investors. It is in between the small investors and the HNI category, but it is a part of the NII category. The remaining two-thirds of the investors can continue to be the HNI category. So, with this segment introduced, the regulator has created a separate subcategory of investors who are neither HNI nor are they small investors. Let's take a look at new rule number 5. New rule number 5 asks, what can existing shareholders do? Who are the existing shareholders? The existing shareholders could largely be the management of the company, they could be employees of the company who are holding ESOPs, etc. Many a times during an IPO, the existing shareholders sell their shares through it's called as the OFS, offer for sale. The old rule was the existing shareholders. You've heard of so many fintech and edtech companies nowadays who are allotting extensively ESOPs to their employees. So the old rule was existing shareholders can sell 100% of their shares completely. The new rule is that if a shareholder holds more than 20% of the pre-IPO shareholding, then they can only sell 50% of their shares. The shareholders who are holding less than 20% of the pre-IPO shareholding can sell only 10% of their shares. So existing shareholders cannot sell off their entire stake during an IPO, which was happening. It happened with Paytm, it happened with Policy Bazaar, it happened with many IPOs that came out in 2021 when employees were looking to encash their stock options. So they were allowed to sell and they could. But under the new regimen, we don't want such rapid price movements, such dramatic price movements. So SEBI says that let there be a cap on what is the amount of shares that existing shareholders can sell. And finally, the role of the rating agencies. You must be wondering, rating agencies and an IPO? Yeah, they've started to make an entry into this field as well. There was no monitoring of the utilization of IPO funds. The new rule is the rating agencies must monitor the utilization of 100% of the IPO money. So there is a clear concern that many of the companies may be raising IPO money and not utilizing it according to the proceeds and the description provided in the prospectus. So now the company that issues an IPO must appoint a rating agency in order to monitor whether there is 100% utilization of the funds. That was a brief description of the rules that are going to be in force from the IPOs for 2022. Thank you so much for listening into the video. If you have any queries, please do post in the comments box. If you have any topics that you'd like me to cover, do suggest them. My content team is waiting to hear from you. Thank you very much once again.